Let's take a look at how an IUL works very simply. So we have John. John is you, me, whoever. John is going to be you today, okay? So John goes and earns money. John takes his money and he goes and purchases a life insurance contract known as an indexed universal life. So let's say he takes $1,000 from his monthly income that he generates at work, right? He puts this money into an insurance company's contract. A small percentage of that is going to go towards an immediate death benefit. God forbid something happens to John right away, it'll pay out to his family. If he gets cancer, stroke, heart attack, brain aneurysm, anything like that, he has access to these funds while he's also alive. But let's just say a little bit's going to go to the cost of that. The remaining amount of his money, which is the majority of it, over 90% of his funds, usually go towards an accumulation account, okay? This accumulation account is linked to an external index such as the S&P 500, BNP, Barclays, NASDAQ, whatever you think. 7 to 10% is the average rate of return. There could be years of 20%, 30%, depending if it's uncapped or not. But let's say an average rate of return of 7 to 10%. This account is linked to an index. It's not invested in the index, so therefore it's not subject to market volatility. John can never lose money. It's essentially a savings account on steroids, right? So he only participates in market gains, never loses any money. He's protected for his family with a little portion of his contributions, but this account is going to keep compounding and growing over time. This money pushes over into what we call a cash value account or John's bank. This is where John can take money out of this policy at any time in his life. Does not matter. He doesn't have to be 59 and a half like Joe, who has a 401k, right? John went and got the IUL, so he could touch his money whenever he wants for whatever he wants with no questions asked, right? So this cash value account keeps growing because the accumulation account keeps spilling over. And when John wants to borrow from it, John takes a tax-free loan from his cash value account. He's like, hey, I have this cash in my account. So he goes to the insurance company. He's like, hey, will you guys give me a loan because you could collateralize it with the cash in my account? And then the insurance company is like, yeah, here you go, John. Here's a loan. Go do whatever you want. And if you die, it's okay because we know we'll pay it off with the cash in your account. And then it's also backed by a death benefit, right? So this whole cycle just keeps rinsing and repeating. And if John wants to pay the loan back, if John wants to reverse this and pay his loan back, he's putting it back in his cash account. Therefore, he could access it again. And all while this is happening, it's never touching the accumulation account. So therefore, this account that has like $1,000,000 in it, $100,000, whatever the amount is, that is still fully indexed, still getting the rate of return because he didn't borrow from that. He borrowed from the insurance company who collateralized it with the cash value in his account. Therefore, he's get uninterrupted compounding growth. One of the only vehicles in the world that allows him to do this, right? And he gets to do it tax-free. He gets to bypass taxes this way. If you want help setting one up, just reach out. We'd be more than happy to see how this could work for you.